Something weird happened this summer. After 44 years of insisting I wasn't a soccer guy, I loved watching the World Cup. I watched with my son, rooted for the United States, and somehow became pulled into Norway. The rowing chants, the energy, and Erling Haaland. But I did not attend a match. I could not justify paying more than $1,000 per ticket or nearly $10,000 for one ticket to the final. The World Cup was great. The price was not. That became a pretty good metaphor for the first half of 2026. In investing, a great company or exciting story can still be a bad investment when too much success is already reflected in the price. The opposite is also true. Bad news can create opportunity when investors have already priced in much of what could go wrong. Investors worried about Iran, oil, inflation, weak consumer sentiment, and unprecedented spending on artificial intelligence. Yet some of the strongest returns came from areas investors had largely ignored. Emerging markets gained roughly 26% during the first half, while U.S. small caps rose roughly 23%. That mattered to us. We began adding to U.S. small caps during 2025 and added emergent exposure near year-end after being cautious for more than a decade. The larger lesson was clear. The best opportunities did not necessarily come from the places carrying the best stories. Oil offered another reminder. The Iran conflict sent oil sharply higher. Then oil fell approximately 38% from April peak by quarter end. Since then, tensions have escalated again and oil has moved higher. Geopolitical narratives can reverse quickly. A long-term portfolio should not depend on predicting their next move. Instead, we looked for areas where fear had already pushed prices lower. That led us to consumer discretionary companies. Consumer sentiment entered the quarter near historic lows. Consumers were worried about inflation, gasoline prices, and the economy. Those concerns were real, but widely known. Our investment screen showed many consumer discretionary companies trading below their own average valuations over the prior decade. The news was bad. The sentiment was worse, and prices increasingly reflected both. We added to consumer discretionary exposure across most portfolios using an equal-weighted strategy. We did not add because everything looked good. We added because everyone already knew what looked bad. That stands in sharp contrast to artificial intelligence. We believe AI will be transformative, but transformative technology does not automatically make every related investment attractive at every price. The largest technology and cloud companies have projected combined 2026 capital spending approaching $700 billion. That creates an extraordinary hurdle. Some important questions to ask are: who earns an acceptable return? Who owns what AI learns, and who ultimately captures the value? AI can succeed spectacularly without every company funding it, or every investor chasing it, earning spectacular returns. In AI, investors have focused heavily on what could go right. In consumer discretionary, investors have focused heavily on what could go wrong. Technology changes. The basic arithmetic of investing does not. Competitive advantages, cash flow, return on capital, and price still matter. Investing also keeps you humble. Our emerging market allocation performed better and sooner than anticipated. Our small cap positioning was more mixed. One strategy lagged the broader rally by more than expected. A disciplined process is not one where every decision immediately works. It is one where you evaluate what worked, acknowledge what did not, and determine whether the original thesis remains sound. As we enter the second half, we are watching the consumer, oil, and Iran, and whether AI cash flows begin justifying the enormous investment. These are not predictions. They are guideposts for determining whether today's prices are too optimistic, too pessimistic, or roughly right. Watching the World Cup with my son also reminded me that people everywhere want many of the same things. We want to improve our lives, create opportunities for our families, and leave something better behind. That is one reason human progress and long-term investing in productive businesses has endured. Investment intelligence is often less about predicting everything that will change. It is about understanding what is unlikely to change and recognizing when prices forget it. A great story can become too expensive. A difficult story can become attractively priced. That is how wealth is built, by choice, not chance.